Yes. Yes, there'll be a couple changes and updates to make things more recent. So a little bit of numbers that should be updated, and we are coming up with some extra edits that we're going to put together soon as well, content-wise. So there will be kind of a new version, a new edition, if you will, coming in soon. So you'll notice a couple things on your desk. On your desk, you'll get a nice little goodie bag, so you can carry all of the tons of things that we like to throw at you, all of the handouts and material and different stuff. We've got this book, Active Retirement Investing, which really was kind of the genesis for all of this, which is something that my father initially wrote, and then I came in to help, and we put it together and really created this as sort of like a Bible in a way of just like, this is where a lot of the information comes from. And I'll expand on a lot of things you can find in here, but if you ever just want to read with something in your hands, this is a great resource. You'll also have a little notebook, which will make it easier for you to retain a lot of the information in here. There's a lot of details. There's a lot of stuff going on at a lot of times. So it's important to understand, like maybe you just need to write something down and look it up later. We've also got a couple different things here, which you probably received if you saw us at the open house. So you'll see like a class schedule that just lets you know what we're talking about every week. And then you'll get this nice little helpful financial terminology, which just gives you some definitions for a lot of things where I might not just think about it because of my time in the industry. It's just kind of how we speak. So if you hear something that you don't understand, feel free to ask a question, but also it'll be in here. We're also building out on our website, activeretirementinvesting.com. We're building out a glossary and some written materials so that if things confuse you and in the meantime you want to go look them up and learn yourself, we're going to try and have a nice full library of different terms and phrases and what they mean, and just help translate them a little bit better. So the last thing that I want to talk about that you will have received is this little document here. It just kind of goes over some of the things that we're going to talk about, so that if you want to know what's coming up, there's a few things in there. If you aren't going to come back next week, or maybe you take a few weeks of a break, you know that there's these interesting things in here that you might want to look out for on the schedule. And then on the back of that, we just have this little checklist. It's not completely comprehensive. It doesn't cover every little thing that you should be doing, but does help push you in the right direction of where you want to go for all different categories, from investment planning to tax planning and estate and legacy planning. So there are some things in there, some considerations to possibly have. Now that you know what you've got, let me start off with the most exciting part of my presentation today, which is our disclosure, of course. We're here just for educational purposes. I'm not intending to solicit you to use any products or use any strategies in particular, or have any business engagements with me. We're here completely for education, and these statements reflect our opinion, and it's not, you need to be able to do your own research and verify the things that I say as well. So just understand, educational seminar, I'm trying to empower you, but also hold that responsibility in your hands as well. There are a couple different regulatory authorities. So, in case you ever have problems with people in this sort of industry, the Financial Industry Regulatory Authority looks over some people like us and broker dealers and people that buy and sell stocks, and the Securities Exchange Commission looks over those products themselves and is kind of the big dog in our industry. So there are people watching out for us. Now, just want to note that by remaining in the class, you acknowledge that you've read this, and you can request clarification of any part of this by calling our office at 916-863-1266. So if you got any questions about what that means, feel free to give us a call. Now, the second thing I do want to say is that these seminars do get recorded so that people can watch them afterwards on our website. Now, a couple things. One, we're not aiming to get anybody's face in these videos. If that ever happens, we get those cut out very quickly. But if you either don't want to be present, if you don't want your voice to be heard, just let us know, and we will do our best to obfuscate anything or just replace it with subtitles or whatever makes you feel comfortable. And if you don't want to be around that, that's okay. We're on Zoom as well. And the reason they're recorded is so that you can go watch them at any time at activeretirementinvesting.com. I want that website to become your resource as much as possible. So if you can think of anything that you would like to see, please feel free to let me know. But go ahead and hop on our website sometime. You'll see it all over marketing materials, and I've got little business cards that you'll see it on. I really want to grow that. And we'll have a newsletter that you can join where we'll just give really just high value things. I'm going to try and make it just no fluff, just useful insights that you can look at and go, does this apply to me? And if it does, you can go make a change today or the next day, and it'll be something positive for you. So by staying here, you're acknowledging that you've read this disclosure, all the same stuff. And if you want to have questions, you can call us at 916-863-1266, or you can find my email and contact me as well. And I'm happy to talk. Couple emergency phone numbers that they want us to run by you just so that we have these. So if any of you are interested in taking these down, we've got just kind of general emergency services. These are better for, some of these are better for calling from the campus because they'll get here faster. So bunch of things, transportation and parking services, if you need transportation, all that kind of stuff. Here's a bunch of other phone numbers like Student Health Center, Health and Safety, Hazmat, Victims of Crime, all that kind of stuff. So we will have those as well. Now, also, they want me to let you know, this week's Friday Forum will be at 3 p.m. Cap Radio Strides, September 15th. And does it say the room? Shaniqua, do we do? Okay, okay. So what is...
The room is Mendocino 1008.
Bingo. Okay, that's where that is. All right, and then they also want us to talk about some environmental stuff. So it looks like a special program for RS members only at the Nature Center. Presentation by a naturalist and guided tours in small groups. It sounds kind of cool. Limited to 45 participants, so join now. Now, let's get into it. First of all, who am I? Let me tell you. So my name is Nashoba, but you can call me Nash. My last name is Bailey, and I'm a financial advisor with Wealth Strategies, Retirement Asset Management, and we are affiliated with Osaic Wealth Advisors and Osaic, the broker-dealer. So to kind of explain that relationship, the broker-dealer Osaic and registered investment advisor Osaic are the people who provide us the foundation and the framework for us to do our business. We operate independently, so our opinions are not the opinions of Osaic, but they make us stay responsible. They make us maintain our fiduciary duty to our clients and make sure that when I'm creating these slides in this education, that I'm putting out factual and useful information. So they're the people that are looking down and making sure that I'm doing my job and I'm doing it correctly. Yes.
It's not like Fidelity.
So it is kind of like a Fidelity because they will provide products for me to use. So when I buy and sell securities with clients, it's via their platform. So I'm basically on them. You can think of them as like how Vanguard, Fidelity, and Schwab, like they have retail accounts for you to hold your stuff at. They'll also have financial advisors on staff that are affiliated with them. So they can provide both sides of that service. So Osaic is similar in that way where they can have investment accounts. They have advisors that are affiliated with them. And then there are people like us who are independent representatives of that company. And we basically use them because we like the tools and abilities that they give us to work with our clients on an independent basis. So I hold the Chartered Financial Consultant designation from the American College of Financial Services, which is basically, it's a bunch of courses in a row of how to do financial planning. That's really what it comes down to. When it comes down to cash flow and all sorts of personal finance things, insurance coverages, estate planning and trusts, and investments and annuities, and all sorts of different things, a big, broad range of things. But it really helps me. I found that this was one of the most helpful things to get me jump-started into the industry. So I knew what I was talking about. And then the second most important thing I've ever had was experience with clients. So I have a couple designations as well from the Institute of Business and Finance, that being Certified Fund Specialist, Certified Income Specialist, Certified Tax Specialist, Certified Estate and Trust Specialist, and Certified Annuity Specialist. So that's just kind of like my background. I've been actually an advisor for about the last 3 years, since 2020. Oh, wow, actually might be 4 years, 3 years now. So 2023, 2024, and then 2025. And I have been in the industry working in the family office since I was very small, but we're going to say 18. So that was 2016. So I've been almost 10 years in this office working around our client base and around the experiences that has allowed me to see. And that's been really helpful in cluing me in to understand what I'm going to talk to you about today and going forward. So with me here is my father, Hunter William Bailey. You want me to take care of the introduction or you want to say anything?
Oh, you can.
All right, okay. So he's my father and he's the founder of Wealth Strategies Retirement Asset Management Services. So he's been offering financial planning services since 1980. So sure, I have a lot of technical know-how and I have some experience of my own, but to back me up, I have a lot of years of time in the industry, of seeing things that have happened, good and bad, right behind me as part of my team and me as part of his, along with our incredibly impressive administrative staff who work all the time to make sure that all of our needs are met, and they help me put together a lot of these things. So a lot of the materials that you're seeing, a lot of the slides, a lot of the content, and the ways that we got here is just completely due to our administrative team, and we couldn't do this without them. But Hunter, or Bill, as he likes to be called, he has a couple designations of his own from Institute of Business and Finance, which are all the same ones that I have. So similar bit of experience there, but he also has a Master's of Science in Financial Services from the Institute of Business and Finance as well. So if you can't tell, this is kind of our thing. Like we do this with a lot of our time. This is what we're interested in. And what I have become passionate about is really just making sure that everyone, not just the people who I serve as clients, not just the people who can afford expensive services, not just the people who got interested in it early on, but everybody can get at least some baseline knowledge and understanding of how to move forward with this because it's a complicated space. So again, I'm always going to keep saying it, but activeretirementinvesting.com, give it a visit. Videos will be on there, information about the live seminars, and a glossary of terms will be available all the time. Always trying to add more things. And you can always email me as well. And there will be a newsletter you can sign up there too. So go do that. So class number 1 is going to be an introduction to how the structure of this is going to go and what are some of the things that we're going to talk about as we move forward. So you'll see the word phases and goals and things like that. So what we do is we like to break down financial planning a little bit. It can be very, very detail oriented. And if you don't understand how you got to the details, it kind of makes all of that really fuzzy and it's really difficult to understand. So we kind of like to break things down into phases. But before we get into what the structure is, I just want to talk about some stats that I find interesting. So less than 50% of American adults have the recommended emergency fund, which if you're curious, is between 3 to 6 months of expenses, just kind of stashed away in cash. Now, in this economy, it's been really hard for a lot of people to maintain that. And this is for all American adults. And that just is kind of scary to not have emergency expenses at hand. Just 32% have investments outside of retirement accounts. So even if they have a 401k that they barely contribute to, they don't really have anything other than that. They don't have anything other than their 401k or their IRA, even if it might be necessary. And only 41% at all have even addressed retirement savings needs. Now, I know that these numbers can be a little bit more important for the younger generation, but it's really important to understand sort of the context of why we're here and why we're talking today. So here's another one. There's this little quiz that FINRA put together, which is one of the regulatory agencies of our industry. They put 6 multiple choice quiz questions, and they asked respondents to gauge their financial education literacy with them. On average, adults were able to answer half of the questions correctly, with a mere 7% of people getting all 6 correct. A lot of people struggled, particularly with compound interest and bond prices. Now you're hearing FINRA, okay, regulatory agency of financial planning, these 6 questions, and only people weren't able to answer more than half on average. Like, okay, well maybe they were kind of complicated, and maybe some concepts, if you're not introduced to them, can be a little complicated. But let me take you through what it is. Here's the first set of 3 questions. Number 1, so I'm just going to gauge kind of what you guys think. We're going to see how you do in comparison. So number 1, a 15-year mortgage typically requires higher monthly payments than a 30-year mortgage, but the total interest paid over the life of the loan will be less. Do we think that's true or false? Okay, yeah, we think that's true. Suppose you had $100 in a savings account and the interest rate was 2% per year. After 5 years, how much do you think you would have in the account if you left the money to grow? More than $102? Exactly $102? Or less than $102? More than $102. That was the compound interest question they were saying people struggled with, by the way. So just imagine that the interest rate on your savings account was 1% per year and inflation was 2% per year. Now we're getting a little more complicated. After 1 year, how much would you be able to buy with the money in the account? More, the same, or less than today? Less. Exactly. So you all got it right. So you're doing way better than the average. So already I know that this is going to be great because you guys are smart. Here's the next set. Buying a single company stock usually provides a safer return than a stock mutual fund. True or false? Bingo. Suppose you owe $1,000 on a loan and the interest rate you are charged is 20% per year compounded annually. If you didn't pay anything off at this interest rate, how many years would it take for the amount you owe to double? This one's a little bit more complicated. Less than 2 years, at least 2 years, but less than 5 years, at least 5 years, but less than 10 years, or at least 10 years. What do we think? Ooh, see, this one's taking you a little bit.
Didn't pay anything off, that means you didn't make any payments.
Right, exactly. So you're not paying anything off. Well, okay, well, obviously that's going to be a consequence. But when we're talking about this financial amount, how long would it take for $1,000 to go to $2,000, essentially, with 20%? Okay, well, we'll get there. So if interest rates rise, what typically happens to bond prices? This is my favorite one because it's actually about investments. Riz? Okay, I hear a couple different answers. Okay, so obviously you guys got the first one right. And the second one, it's at least 2 years, but less than 5 years because yes, at 20% per year, if it was 20% of the original 1,000, it would take 5 years exactly. But as that 20% gets added, the next 20% goes on the total value and then again, and then again. So it's a bit less than 5. And then when interest rates rise, bond prices do typically fall. I won't spoil exactly why that is yet because we'll get into that in a later time. But here's another thing. For retirement fluency, now let's get a little bit more relevant. So there's a bunch of people that correctly answered retirement-related questions and percentages here. So for Social Security benefits, about 42% of people were able to get questions right in the TIAA's survey. About 30% of people were able to get questions right about Medicare coverage of healthcare expenses. About 44% of people were able to get employment-based retirement savings questions correct, 53% for ensuring lifetime income, and 32% for life expectancy and retirement. Now, I'm going to take a guess that a lot of the times when you see this phrasing, ensuring lifetime income, that sounds like annuity products to me because nobody's able to guarantee income like annuity companies. So a lot of the times they'll use a little bit more forgiving language than our product, but that's just my guess. So risk comprehension. Now, this is probably one of the most important ones that I see people struggle with all the time. A lot of people really struggle with comprehending what risk means, what it does, what it's good for, what it's bad for, or just what it is, period. So Gen Z is tied with the silent generation for being the lowest score on comprehending risk. Now, let's see, it looks like Gen Y and Gen X are beating out baby boomers. And any answer under 40% is just concerning when it comes to, going and investing and getting your money out there and getting it to work and creating financial plans. Risk is one of the most important things to understand. It's like, it's right up there with knowing what you're going to do in the first place. And then the second one is how much risk are you willing to take to get there, or can you take mathematically? So to see that this number is so low, it worries me. And this is one of the ones that I want to see be higher. I want people to understand risk much clearer. Yes. That could absolutely be. Yeah. So honestly, I'm going to give them a pass for this one. I think we're doing okay here. Yeah, exactly. So one of the charts that I like to look up is there was this period between 2021 and 2022. These are two what are called target date funds. If you know what a target date fund is, fantastic. But for those who don't, essentially what it does is you have a target year and they say by this year, we're going to get to our most conservative mix of stocks and bonds. And we're going to start with just basically all stocks, very little bonds. And then every year as we get closer, we start to change that ratio so that the risk level changes. Now, these are two funds that have targets of 25 years apart. This one is 2025 and this one is 2050. Now, curiously, both those funds dropped exactly the same. Because bonds weren't necessarily able to completely insulate your level of risk at this time. At this time, stocks and bonds crashed at just about the same amount. It didn't really matter where you were. So it's not just stocks versus bonds that determines your risk. It definitely helps. And over the long term, bonds are way less volatile. Absolutely. They don't move as much. But it's going to save you from a moment like this. So it's understanding, could your portfolio survive this drop? Could you pay your bills? And if not, then it's important to understand what changes need to be made for it to shift in the other direction. 35% of American adults say they have personally experienced a family conflict or know someone who has as a result of not having an estate plan or will in place. It doesn't really sound like it should be a problem for a lot of people, but one thing about estate planning is, yes, sure, it's about leaving money to children and making it go here and making sure everybody gets what they need to get, but it's making it happen in the way that you actually desire for it to happen. Because if you know anything about the probate process versus having a trust or some other like contracts on beneficiary designations on accounts or something, when you have actual beneficiary designations to people where it just goes straight from the investment account or trust account or whatever to the person, it just smoothly moves and it makes it there. They contact the right people who need to be contacted and nobody else. Versus probate is a very public process. It's all out there. Like if you go through probate, that's all going to be public record. So anybody, including any of the beneficiaries, anybody who might not be so happy with their share, can see all of the information and exactly who got what. And that can create a little bit of drama. So it's important to understand that it's not just about, I have all of this money. It's also about, I have relationships that I would like to preserve even after my passing. And so it's important to be able to look into that and understand all these different angles. And then the next thing is self-insuring long-term care. Here are some of the numbers for average cost of care in California as of 2023. Homemaker services being almost $7,000. Homemaker health aid being over $7,000. Even adult day health care, almost $2,000. Assisted living facility, a private one bedroom, $6,000 and a quarter. And it's often more than that. I mean, we've seen numbers of more like $20,000 a month.
Is that per month?
Yes, per month. All of this is per month. So, if it's per year, fantastic. All right, we'll go with that. But $6,000 a month, $20,000 a month, depending on the type of care. If you don't have long-term care insurance, you are self-funding. That's what's going to happen. So it's just a question of for how long and how is this all going to be handled. So seeing that into your plan, even if you don't expect it, even if it's not something you really think is going to happen realistically, there's always a possibility, and it's important to understand what's going to happen if it does. So to wrap kind of all that up, because that's just kind of the intro, we're not even getting into anything yet, but the actions we take today determine our outcomes. It sounds really simple and really obvious. The choice you make today gives your outcome tomorrow. Of course it does. But so often we neglect the importance of each and every step along our way. So walk with intention, live with purpose, and don't let your future be an accident. Hold the reins of your financial future, even if somebody else feeds the horse and maintains the tack. Be your own advocate and be the one for the people in your life. Make it count. Don't guess, but plan. It's what I will say many times and what you'll see on marketing materials. Don't guess, plan. You don't want to just run it with like, I don't know, maybe it'll just work out. Maybe it will. And if it doesn't, what's going to happen? Do you even know? So it's important to plan. It's important to see what the results are going to be. So no matter what, if you don't come back after today, just make choices with intention and look at the things that we have provided you. Look at the website. Look at the things that everybody says. And we just go, yes, I know everybody knows that. Yes, they do. But does everybody do it? Not really. So be intentional and get out there and do this. Understand if somebody's doing it for you, what it is they do, and value that. That's important too. So whether you do everything yourself Total DIY, I don't want to pay anybody. Good for you. We're here. If you have an advisor already and you just want to know what they're doing working for me, is this plan going in the right direction? Fantastic. We're here for you. And if you just want to learn, where do I even begin? We are also here for you. That's why this is here. It's not as a sales thing. It's not to get you over here. It's just to provide you with enough confidence that even if you're working with somebody else, you go, now I understand why they're doing what they're doing, and I have full confidence, and you can move forward. So there's a bunch of things that we're going to cover in this class. This is going to be some of the most basic material today and the next couple days, but as every class goes forward, it gets more and more in depth and more complicated. So you will find a lot of details in here. So we'll talk about goal setting, prioritization and quantification. How do you actually create a goal? Like, what is it? How do I quantify what I want to do so that I can put it into numbers and move forward? Basic risk management and insurance planning, which is really just making sure, are we insured against the things that we can't, like car accidents or liabilities or all sorts of things? Like, there's reasons that insurance exists. So we're going to do an evaluation of, are we covered in the different places that we want to be? Mission critical estate planning topics. I'm not an estate planning attorney, but there are a bunch of key things that are just really important to understand so that when you are doing your estate plan, you're doing it through the right frame of mind and understanding sort of the functionality of how things go. So I'm not going to write your will, but I can help you figure out maybe what to put in there. There's a three-phase approach to financial planning that we do. One of the things I was going to say before, I got a little ahead of myself. Financial plans often come in this really big stack of papers. There's a lot of numbers, or it's a big long PowerPoint presentation like I'm doing right now. And that can be great. And if you've got a lot of details that you need to figure out, that's fantastic. But they can also be overwhelming. They can also be a little confusing. And the person communicating it to you always has to do a really good job of making sure you understand everything that's said. So what we decided to do was kind of break it down into just kind of go down a level and say, what are the main things that we need to make sure we cover? And just sort of get the basics done so that no matter what, like, yes, there's details and optimization and all these little teeny tiny numbers that we could focus on, but what are the core pillars that actually keep us moving forward? And that's our three-phase approach to financial planning. We'll talk about what those are in a second. We'll get into in-depth investment analysis, which I'm sure is what some of you are here for. It's my favorite topic, and I have a lot of fun talking about it. So we'll really get into what for each security, like what they are, what they do, what kind of risk levels they have, how you can mitigate against different things, how to deal with super big concentrated stocks in your portfolio, how to understand that your risk level is actually where you want it to be, and what that's going to look like, and be able to be comfortable with it. And we'll get all the way down to really fun, like risk analysis and Monte Carlo stuff, and it'll be a fun time. We'll talk about our guide to diversification, which is just essentially how we build portfolios at our practice and how I hope to shine the same light on you. I'm not doing some crazy high fee strategies. It's very basic things, but it's doing it with intention and with purpose and with connections to everything else in the plan that's really important. We'll talk about some post-planning activities, which, spoiler alert, that's our third phase. Once you get everything built, it's important to maintain it after time. So we'll talk about what are some of the things that you should keep doing. Even if you feel like you have a financial plan and you're doing the steps, what do you keep doing beyond that to make sure that you are going in the right direction? And then at the very end, we'll talk about evaluating professionals, their services, their fees, all that sort of stuff. So if you're looking to work with somebody, or if you're working with somebody already, you can kind of evaluate what it is you're getting or what you're looking for and have a realistic expectation of what that should be like out in the marketplace. So number one thing is actually have goals. Actually have things that you want to accomplish. And they can be really easy. It can be a life of lower stress with a certain risk tolerance. It could be a certain amount of income for the rest of your life. It could be to leave a certain thing to your kids. But it's important to understand what those goals are and like what are the details? Like what do I need to accomplish? How far do I need to go? What do I need to put together? So there's a bunch of different things that you could do, but here's just like some ideas. You might be thinking about maximizing retirement income to a certain level. How much, like, I need a certain dollar amount to sustain my life. I have these many assets. What do I need to do moving forward? Reducing income taxes. You might be going into this thinking, I have no idea if I'm paying the right amount of taxes. I just do what my accountant tells me and we just go from there. So there might be some things that we can do, some things we can make more efficient, especially on the long term, to sort of reduce your lifetime tax liability. Inflation protection is probably going to be one of your most basic ones. I don't want my dollars to just lose to inflation every single day. And there are easy ways to combat that. I mean, right now, high yield savings accounts are all over the place and they're fantastic. If you don't want to take any risk and you just want a little bit of interest for your time, those really help combat that. Same thing with like CDs, treasury bills. So there's a lot of tools that we can use to combat inflation, especially over the long term as well. Funding family education might be important to you. There might be other children within the family or grandchildren or anybody that you just want to give a helping hand to, but you don't want to necessarily harm their abilities to, go get aid or certain types of things. So there's a lot of different ways that we can structure assets to help our children and grandchildren to help them get through college and whatnot. Tax efficient estate planning. So, there's the taxes all the way up through your lifetime, but then there's also how they land on the people that are receiving them. Now, obviously, for a lot of things like homes, individual investment accounts, whatnot, you have that beautiful thing called a step-up in basis, where basically you have what you paid for it, what it's worth on the market, and you know that if you went to go sell that, bunch of taxes built in right here. But if you pass and you leave that directly to somebody else, it goes away as if they bought it the day of your death, and that's their cost. So there's no taxes there. So that's pretty useful. But there's other things where if somebody's going to receive an IRA account, that doesn't exist because the money was going to come out completely taxable. There's no cost basis. So it's important to understand who's getting the IRA, who's getting the tax-free money from the Roth IRA, who's getting the tax-free proceeds from the life insurance, who's getting the rental properties, who's getting this. Understand how that works and how it might be more tax efficient to choose different beneficiaries depending on who's receiving what. You might want to just have a little bit of fun in retirement. I often am encouraging clients to do that. So when they are able to stop worrying, they actually go and enjoy themselves. So you might want to understand what is a responsible way to do that. What's a responsible way to quantify that and put that into my plan and go, I just do this regularly. It's all going to be part of the same thing. We're going to be all right. And then, of course, there's protecting what you have. A lot of us, when we start to build our nest egg, we get very protective of it. We don't want to see it go anywhere, rightfully so, because you worked really hard for it. So how do you know that you have your protection, you have your shield, you have your men around you, you have your team that are holding you together so that no matter what happens, you will have some protection? There's a lot more that you can do. But just start thinking about what the goals are, especially so that if you keep coming back, you can ask particular questions relating to that goal. So if I miss something and if there's something you want to do, you let me know and then we'll figure it out. Here's some of the top financial goals. Now, these are just going to be across all generations. So these will be a little generic, but a decent amount of people have paying off credit card debt as one of their goals. A lot of people obviously just want to cover their bills, but these are small things. Improving their credit scores. Looks like not too many people are worried about that. Say they got it down. But a lot of people don't have one. I mean, seeing a 20% of not having a goal, 20% of not having a goal, 10 or 11% of not having a goal. There's just no direction. If there's no goal, there's no direction. There's no way that we're moving towards. Saving for retirement is great. Save for a new car is great. Buy a new home is great. But think about those big ones. Think about what you want to be able to either accumulate, help your children accumulate, what you want to distribute, how you want it to go, how you want to help people. Really get those ideas down. So here's just something, I'm sure you've heard of SMART goals. I'm just going to quickly run through this. SMART goals are 5 things. They are specific, measurable, attainable, relevant, and timely. So it's specific because it needs to be tangible. It needs to be a number or a time or something that can be measured. Everybody knows what this looks like. Again, measurable. We need to be able to see that there's a measure of success to where if we reach a certain point, it has been completed. That is important to know as well, because if it's just going on forever, it's a little hard to measure that and put into numbers how we're going to get there. It has to be attainable. So obviously, I can't go out and say, like, I'm going to invest in the S&P 500 and get 50% returns every single year for the rest of time, because it's not attainable. Most likely, that's not going to happen. So we have to put something together that may be challenging, but it has to be achievable with our resources. And there's a lot of ways to understand what your resources can do, but it has to be within what it is capable of. Has to be relevant, so it has to meaningfully contribute to the larger objectives. So if we have like this wonderful financial plan that's taking us in the right direction, and then we set this big goal that just takes us on a complete tangent. One of the most important elements of a financial plan is time and consistency. When that starts to fall apart, all of this other planning that was done falls apart with it. And then timely. We got to have a deadline or a timeline of progress milestones so we know that we are on our track to getting there. So quantifying goals can be done in a couple different ways. We want to quantify our goals into attainable numbers. We want that we are able to create with the numbers that we have in our investment accounts or the numbers that we're putting away. We want to understand like what it is that we want. Do I want to have X amount of dollars per year for this many years? Is that part of my goal? Do I want to have a certain amount of dollars at this coming year? And sometimes those might both be part of the same. So we're going to talk about something called time value of money. I'll just go through the basics of this. We don't need to do a whole bunch of calculations, but there's the idea that, let's say if we're talking about an income stream, right? So if you're going to get a certain amount of dollars for a certain amount of years, starting at some future date or at today, there's going to be a big value, a present value of all of that income going out. So if you've got a certain amount of dollars coming out per year and the portfolio is achieving a certain amount of return, it's not just going to be the flat amount of dollars kind of added up that came out each year, but it will also be a factor of that interest rate or that growth rate, whatever's happening in that portfolio. So there's going to be a present value. There might be a future value of if you are putting a certain amount of money to work each period or year that it's going to add up to in the future with interest. So basically the pieces of that will be present value, the future value, the interest or earnings or growth or whatever, the amount of periods that it's over, usually in years, and then payments in and out. All of those things will affect each of them. Usually you'll fill everything except for one, and then you'll calculate for the last one left. And there's a lot of great financial calculators out there. They're really simple. You just plug these numbers in, you calculate it, and it helps. So these factors will help you filter the actions you take or the actions that are recommended to you by other people by what fits your specific goals to make sure that things align. So I guess it would be good to understand yourself as which type of investor you are, which type of client are you, which type of, active retirement investor, if you will. Which kind are you? Do you do your own investing? Well, then you should be as qualified as the person you'd hire, at least to the level of doing things yourself and making sure that you're getting it right. You don't have to have the designations. You don't have to have the degrees and everything, but you have to understand the components of what you're using. And that might be that you use more simple components to do the same job, which might be just fine. Don't be afraid to delegate sections you're not an expert in. A lot of people like to be the investing expert because it's fun, but they don't really want to do taxes. And so you can hire a CPA and still do the other thing yourself. Don't be afraid to delegate those sections because it's important that you get the same level of care for every single segment of your financial plan as the one that you're the most interested in. If you're using an advisor, it's really important to check their background. So BrokerCheck is a great one. You can look me up if you want on there. If you go to BrokerCheck and you put in the name of an advisor, it'll pull up their credentials, well, it'll pull up their licenses, it'll pull up the places they've worked at, and if there's any disclosures that they've had to make to FINRA, it'll show those too. So that's a good tool to use. But be able to evaluate the advice they're giving you on a basic level. There's something that I see a lot in this online community. They're called the bogleheads. They follow Vanguard and low-cost funds, and that's kind of like their whole thing. And we lean into a lot of that. But oftentimes, when they're working with advisors before they pull out to do their own thing, they don't really even understand what they're being told and why it is or isn't right for them. And so when you just go, yeah, sure, I mean, I guess you got a couple letters after your name. Yeah, why not? Let's do it. You might not be getting the best that you should be. Now, every financial planner should be a fiduciary. They should be acting in your best interest. But it is our responsibility at the end of the day to make sure that we are also receiving a high level of care and a high level of service from professionals. So be able to evaluate the advice that they're giving you, even just on a basic level. And even if they take it to another level, you go, okay, that's too complicated, but I still get how it fits. I get how it's part of this. That's the important thing. And when you're looking for answers, if you're looking online, if you're asking me, if you're talking to anybody, just know how to sniff out some of the garbage. Know when it stinks. Know when it's a little too good to be true. It's not really telling you what the truth is, and it's just trying to get you to make a purchase or pay somebody's fee. Know when it's just, okay, that's too far out of left field. I got to go back to the center path. And keep suitability top of mind. That's another thing. One of the things about being able to evaluate the advice is if somebody suggests you some really advanced investing strategy or tax strategy, and it comes with all these fees or this big annuity that has all these different features, I really want to know, is that suitable for me? And why do I need this? Can I accomplish this in a different way that's more effective and cheaper? That's always something. We love low-cost products. That's our favorite thing because fees end up being the number one detractor of returns over time. It just kind of is how it goes. So we'll kind of look at what a traditional plan looks like before we look into what we're going to cover in terms of structure. So there will be many times a letter to the client, a copy of the original engagement letter, and then a table of contents that talks about all the different stuff that's in there, a lot of introductory material like mission or vision statement of advisors, statements of their principles, their ethics statement, their privacy statement, their investment policy statement, assumptions and disclosures and lots of things, client profile, a summary of all the goals and assumptions. So if you've gone and gotten a financial plan before, some of this will look familiar. And I mean like hard copy or presentation financial plans. There might be like a quick executive summary of all that's in there, and then all these different things in there, all of this cash flow analysis, net worth analysis, tax analysis, property and liability insurance, all of these wonderful things. And so this is like really what you should be expecting from those big financial plans that they plop on your desk. There's some specialized analysis in there, implementing and monitoring section, acceptance of client engagement, all appendices and projections and education materials, and that's great. But I really just want to give you foundational stuff to get started. So what we'll break it down to is our three-phase process. So number one is where we talk about basic financial planning concepts. It's when we talk about things like cash flow, having at least having a budget, where we talk about insurance planning and making sure that you don't have any big giant liabilities that could come bite you later, looking at estate planning to make sure that, if you have at least some things going in the right direction and you can craft something that's following your wishes, tax planning to make sure you're not just chucking away extra tax liability. And then we'll get to the investment portfolio where we really build the engine of what's going to drive all of this forward and how we're going to get to where we want to go. Then finally, post-planning maintenance, which is really just stuff that you should keep up on afterwards. And all of this is also what we expect of an advisor as well. So phase one, what are we talking about? We're talking about cash flow. That's both for right now and for the future. It's important to understand what our money in, money out situation is. It's boring, I know, it's budgeting, but it's important because we have to be able to quantify it in order to create plans for anything else in here that supports those numbers. Otherwise, if your cash flow is pretty stable for a little bit, and then suddenly you decide to 5x your lifestyle, I don't know if any of this is going to matter anymore. So it's really important for you to understand in and out, have it be measurable, and be able to, you can allow yourself to spend on things, but just know what the amount is. That's the important part. Again, risk management, insurance coverage, knowing if you have liability from a business, tax planning, pinpointing your missed opportunities, or if you're just paying too much in taxes for really no reason, and we could do something else where over the long term, the liability might be smaller. Estate planning, how are you distributing assets when you pass? Where do they go? How are they getting there? How are they protected from family disputes? Are they tax efficient? Investment analysis. So though we're not building our portfolio yet, it's really important to look at what you've got and see if there's anything we need to change quickly. Because if your risk is way too high for where you're feeling okay, that might be a problem. We'll talk about this more later when we get into risk levels and suitability and building portfolios. But one thing that's really important to understand about risk, there's all the math behind it. And that's wonderful. And that's what I work with every day. But the thing that I work with risk when I'm talking to somebody is at what level of loss or volatility would make you change something about the plan and make you go off path. There's a study from, I don't remember if it was Vanguard or from Fidelity, it was from one of the big companies, and they were talking about how investors on average did 3% better per year with an advisor than without one. And I'll tell you something, it's not because of what they put the client in, it's because more often than not, they were the ones who talked their clients out of prematurely selling when their investment strategy was already in track with their plan. So what's important is that if you're going to do it yourself, understand what are the barriers of volatility where you're going to feel okay. You're not going to change anything because what you've set up is going to get you there. But if you breach that level, are you going to suddenly panic sell and then you're going to hold in cash and you're going to hide under the covers for a while and then come back and have missed out on a lot of market returns that would have gotten you closer than where you were for having pulled out of the market? So that's something we'll talk about more later. So our objective with all of this here in phase one is to create a comprehensive path forward that addresses all your concerns and needs to the best ability possible. Now, we're not looking for the easiest solution. We're looking for the best one. You can go a little bit in the middle. I like to bias towards things that don't cost a lot. You can pay for a little bit of ease. You can pay for a little bit of convenience, but just really evaluate what you're getting and what you're paying for. In phase two, we will talk about the investment portfolio. So we'll talk about risk profile and suitability, basically what I was just talking about, and also what level of risk is appropriate for you mathematically and emotionally, and what investment types are suitable for your needs and sophistication level. There are a lot of products out there and they get frisky and complicated and all over the place. And there's a lot of promises and there's a lot of ideas of what's going to happen. And there's a lot of marketing, especially the marketing budgets for products in this industry is so ridiculously high because the margins can be really, really nice. So understand when something's being marketed versus when it's really being suitably recommended to you and be able to know what investment types are actually going to get you where you want to go. In terms of investment analysis, we want to make sure we know how to evaluate the risk level of investments and what unique risks each investment is exposed to, because every single type of investment has some sort of risk that it is specifically exposed to. And we got to do something to address that. That's why when we have a stock portfolio, I don't recommend holding one stock for the rest of your life and hoping that it happens to be the company that does the best forever. A lot of people are into NVIDIA right now. We'll see. I imagine it'll probably do all right for a while, but I don't know. Somebody else could come into the market. There's a lot of old stocks that everybody loved, that everybody talked about, and they just kind of disappeared. And I don't even remember what their names are because they've just gone away. Then there's portfolio creation. We're using widely available low-cost investment vehicles. We're going to design a well-diversified portfolio that's customized to your needs specifically. Now, what I'll say is a lot of this customization has way more to do with managing the risk levels, understanding how much you need liquid at any given time, how much risk you're willing to take emotionally, and how you're going to stay the course. It's not necessarily that everybody needs a very particular little stock fund or bond fund, or everybody needs something completely different. There's a lot of similar concepts, but making something that's well suited to you, both mathematically in terms of risk, and something that you believe in so that you stick with it for the long term. So our objective for phase two is to achieve your goals at as low a price as we can, while at the same time protecting your assets from all substantial risks as much as is reasonable. So there are going to be things where it's unreasonable for us to try and protect against downside because we need upside. So it's understanding the relationship between all of those different things and how it fits together. Now, phase three. This is when we'll talk about monitoring your plan. Once you've put things together, you have your financial plan, or at least the bare bones of it, your guide, if you will. If you have your investment portfolio put together and it's working for you and you understand it, don't stop. Make sure you're looking back. Make sure you're making sure that everything continues to do what you want. Things may change. The investments may creep outside of their objectives and risk range. You might have something called drift, which is positions that grow too far out of their range or shrink too far out of their range, and you need to bring it back by rebalancing. You might have a new objective. That's one of the most important things that people don't always think about is your wants and needs may change. And now we also need to readjust everything else to better suit that. Regular plan revisions, just making sure you go back on your plan and strategy on a regular basis, even if there's no changes. It's critical to do this to ensure long-term success because it keeps you reminded on what you're doing, how you're getting there, and why this is going to work, why you're going to get to where you want to go. So you don't get convinced by somebody who is naysaying you, just like, when the shoe shiner starts giving stock advice, one of those sorts of stories where you just have a lot of people talking, a lot of people spitting ideas at you, and you don't want them to drag you away from the thing that you have planned to do, from the thing that's statistically probable for you to succeed. That's what I'm about here. We're talking about making it statistically probable for you to continue to succeed at your goals, which is not a guarantee of anything or trying to get you to do more than everybody else is doing, but to just get you to where you want to go in the best manner, in the most probable manner that we can. So our objective here, maintain a plan that continues to fulfill your objectives, even as your needs change, as well as maintain awareness, the regulatory environment. That's the one I missed. Awareness of laws and regulations. There are some big things that may change. There are some little things that may change. But the most important thing is to be aware of how they relate to you. We were just recently, the estate exemption got permanently increased and set to $15 million, the estate tax exemption, which is something that doesn't apply to most people ever because that's a really high dollar amount. But we were worried for a little bit, is it going to stay at the 13.9 or $14 million? Or was it going to sunset back down to half that, less than half that, at like $6 million, which is much more substantial. And there's a much bigger pool of people that sit in that asset level range rather than the 15 plus. So it was something that we needed to be aware of. And it was something that we were, wondering, how are we going to deal with this if we end up in this situation? Thankfully for us, or anybody who has that level of assets above that 6 million number, it's been extended and we don't see it going away anytime soon. So all that's really important. Also changes to tax code and stuff like that to make sure that if you're taking advantage of anything like backdoor conversions or mega backdoor conversions or all of those weird fun tax strategies, making sure that there's still if there's a loophole, to make sure it's not closed or retroactively closed. If you're taking advantage of a strategy, to understand how it's actually working mechanically so that you don't make any mistakes, see if they changed anything about it, and just making sure that you are within the environment, you understand the environment you're operating in. That's one of the other reasons that it's nice to work with somebody, even if it's just on a consulting basis, because they'll be in it, they'll be in the environment and they'll have an idea of what's changing. And you can go, hey, I'm still doing this move over here. Like, is that all right? Am I okay to keep doing that? You can get some reassurance that way. So not every engagement has to be everything or nothing. There's a lot of piecemeal stuff that you can do. But again, our objective is to maintain a plan that continues to fulfill your objectives, even as your needs change, as well as maintain awareness of the regulatory environment that affects your plan directly. So let's go a little bit into what phase one is, just briefly. So phase one is going to include things like personal cash flow, insurance, estate planning, taxes, portfolio, and investments. This is going to be another quick review. But what I wanted to show really was this slide here. This is just a little bit of a demonstration of that portfolio construction process. I want to give you a little bit of a taste before we get there. We're going to talk about a few things before we get to building portfolios. But what we do is we have two versions of integration. We have lateral integration and vertical integration. What does that mean? Lateral integration really is just using two pieces, which is the length of time we have for the investment and the risk tolerance that we're willing to take in order to achieve whatever goal it is. So you're going to have a much different time frame reference for house purchase coming up in a few months versus retirement in a couple years or estate planning in the next 10 or 20 years. All of that's going to make a big difference. So we like to split things up into what are our short-term needs within the next year or couple years, what's in our intermediate term needs, maybe somewhere in the middle, like 5 to 7 years maybe. And then as we get to the 7 and 10 year plus range, we get into this section over here. And the key thing is the risk widens up the further we go out with time. Because as you'll see in some of our classes later, the more time you have, the more volatility you can withstand because of the general upward curve of the market. Those numbers will begin to smooth out, and each super volatile up and down year will become a nice average return over a long period of time. Then we've got vertical integration, which is our diversification and market exposure. So this is when we're talking about what we actually invested in. That tells us what kind of risk we can take, and maybe there's a couple different, key asset classes that we think of. But then when we start doing this vertical integrations, well, okay, so what pieces make that up? Well, we start from the bottom with our super low cost, super broad index funds, little bit of everything, doesn't really cost us very much to do, and it fills up the big portion of our portfolio because we're just trying to use the easy tools that the market has for us and create a portfolio using that. We step up and we get to a place where if we have some convictions, like for example, if any of you are value investors, if that's something you like, this is where I talk about what's called tilt, which is where you kind of move a little bit in one direction where it's like, I kind of favor this section of the economy, or I think this has the chance for outperformance. We just do a little bit of that. Tilt, yes. Yeah, it's like tilting towards, like if you have, you got your tech companies over here, you got your utilities companies over here. It's like, I'm going to tilt a little bit in this direction. I'm going to go all the way over this. I want to be a little in on this conversation. So up at the top here is where we get to some more specific things, like if you have a little bit more speculative things or even just higher cost. Generally, this will be filtered by cost, lowest cost, mid cost, high cost, at least in our opinion. Then all the ridiculous high cost stuff exists up there in fairyland because we don't like it. But you can also use this as an opportunity to use things that are maybe not so proven with time up here. And the reason that this is smaller at the top is so we don't over influence the general sort of easy tools that we pulled together to create our portfolio. And then with phase 3 monitoring, obviously we're talking about our risk levels to keep the risk level in line. As we go forward in our financial journeys, our risk levels do change, not just because of the math, not just because of sequence of returns risk or things in the economy, not even because of all that, but just because of how we feel. We might, as we're accumulating, be very much like, yeah, just go ahead. I'm just going to keep focus on what I'm doing in life and at my career and creating things and doing all these other things. But then you get to this and you go, oh, this is kind of a responsibility. I need to keep this really safe. So your risk level can change. It can go up or it can go down, or something could change in your situation and you don't need so many of the assets that you thought you did. Making sure that those allocations still stay within what you want, with what makes you comfortable, with what you believe. It's okay to use your actual values and morals to choose investments. Just understand what the trade-off is. That's the important part. And then distributions, understanding how those distributions are coming out of your account, what the math looks like going forward, understanding how that's all going to play out. And then for the estate planning, one of the most important things, if you do nothing else, if you leave here today and say, I'm not interested, please double check your beneficiary designations on anything that you have, whether it's an investment account like a 401k or an IRA, a life insurance policy, or even if you're thinking about who you're going to leave your home to, check your beneficiary designations. The last that we want is something without a beneficiary designation, because then it's up to the state. And we don't really like giving them the opportunity to make a mistake on our behalf. That's not what we're after. So review your beneficiary designations, review your trust documents. If you don't do anything else, please do that. Don't let things go in the wrong way. then, of course, keeping up the times like I talked about, staying up on regulations, staying up a little bit on economic news. Don't let every single event that happens in the world completely shift what you're doing, but just think about, okay, how does this relate? Where does it fit? Does stuff like this happen regularly, or is this something new? If it's new, what does it mean? Just understanding what you believe about it, and then still making sure you stick with the probabilities and the numbers at the end of the day, but understanding that if you need to make a change, you need to make a change. So here's a little bit of an outline of all the stuff that we're going to be going through in this class. We are going to have today, which is our introduction, our overview of the phases and goals. We're going to have next week, which is where we'll start digging into the phase one stuff. We'll start talking about the cash flow analysis. We'll start talking about the insurance planning. We'll start talking about estate planning, tax and real estate and all types of things. So we'll get into a lot more details next week. After that, we'll talk about some of the sort of the pieces, the functionality that goes into all of this. We'll talk about account types, types of funds, market indices, what those even are, how to look at your portfolio and diagnose it for different issues, the difference between things like ETFs and mutual funds, and then we'll get into new portfolio construction the following week. And this is where we start to get to my favorite stuff, all of the fun things. We'll talk about the law of large numbers, which is what drives a lot of our investments. I won't spoil the details yet. What dollar cost averaging is and how it does or doesn't help. And then managing the two types of risk, which are systematic and unsystematic. And you can basically just think of this as the risk inherent to the system, the fact that you're buying stocks at all, there's going to be risk in that. And then the unsystematic risk, which is things that are a lot more particular to what individual thing you're in. And this right here, this topic, unsystematic risk, this is our reason for diversification. This is why I don't just hold NVIDIA stock. This is why I don't just hold one type of investment. It's because there are different types of risk that each company is subject to. And unless you're going to be the next greatest hedge fund manager in the world and pick them, the best ones, over and over again, back to back to back, I would rather just make this risk sort of quiet away into the background by holding a multitude of different things that help us get to our goal. After that, we'll talk about lateral and vertical construction concepts, because we'll basically talk about what those actually mean when you look at products, what that means when you look at asset classes, what that means when you look at how it fits into your portfolio, and how we're actually going to put that together and then create a portfolio. And we'll also look at the different types of investors. And as well in both of these classes, we'll kind of be talking about what kind of investors, what kind of objectives they have. So what sorts of products help them get to where they want to go, and what sort of risk tolerances you have, and how you can sort of quantify that and get an idea of what is my risk tolerance? What kind of volatility am I willing to take? So that's what both of those will be really good for. And then in the class 6, we'll talk about actually implementing lateral and vertical integration. So we'll really be putting a portfolio together and actually showing you what that process is like and some products that could be used, all for example purposes. I'm not making any specific recommendations. After that, we're going to get into the really complicated stuff, which is modern portfolio theory. This is what we use to measure the return and the risk of investments. So if you're going to be putting your own investment portfolio together, it's important to, even if you don't use these every day, it's important to understand what they mean. And so that if you see this on something you're invested in, you go, oh, okay, I know what that means, but that's totally fine for what I'm doing. It's just important to have a basic understanding. After that, we'll talk about investment objectives and risk tolerance and portfolios that are based upon investor avatars. So we'll basically look at some different options of people and what they're trying to do and what their risk tolerance is, and trying to match portfolios together. So then after we've talked about all of the how, what to pick, how to pick securities, how to pick in pieces of investments, we'll actually look at, okay, so how is that all going to be put together for somebody based on their example avatar? Following that, we'll get into portfolio monitoring, where we'll really start talking about estate planning, maintenance, tax efficiency management, and just kind of like the overview. There's going to be a little bit about this daily, weekly, monthly, quarterly, all these things that you need to be doing on every regular basis. when it comes to monitoring your portfolio and staying up to date with the financial landscape. Because there's a lot. There's a reason that financial advisors exist, that investment companies exist, that all of these finance companies exist. And yes, while some of that may have been to created complexity, things that were just created just to make more different places for people to go and have businesses, whatever you want to think about how all of those things exist, it is a complex landscape, and it's important to understand how to move through it with confidence and to stay in the right lane. So we'll talk about all of those different ways that you need to stay up on your portfolio and general finance. Estate plan maintenance. We'll talk about how some of these account types, different types of trusts, and we'll talk about an estate planning checklist that's going to be super valuable. So if you're interested in estate planning, definitely come by here, or at least make sure you stay on the email list for this class so that you can get the documents sent out to you. And it'll also be available on the website. So always remember, all the stuff that we're handing out physically will be available on the website. When you go to recorded seminars, you'll see download links for each of these. I don't know how long it'll take after the recording for it to get up on there, but we'll also do our best to provide as many digital copies via email as well to the Renaissance class list. After that, we'll talk about tax efficiency management. So what are we actually doing sort of at the end of the day on the background in terms of tax efficiency? Once we've kind of put our plan together, how are we filtering down? I have these assets in different places. I have these goals that I want to achieve. I don't know if I should be converting my IRA to a Roth. It seems like everybody's doing that. What the difference between certain different account types is going to impact our estate plan. And what some real estate things might mean in there, ways that we can tax efficiently use our real estate assets as well. So if you're interested in how to manage with your current tax situation, this might be very helpful for you. Then all the way at the end, just like I talked about before, first, we're going to do a quick review of everything. We'll go through all the bare bones of everything, and we'll give a chance to where if there was something we talked about previously and we want to revisit it with some questions and discussion, we can do that in the beginning of our last class. And then we'll talk about the differences between doing it yourself, hiring an advisor, or checking in with your current advisor. So we'll really just have a nice comprehensive conversation about everything that we talked about. And then now that you have all of that information, where are you going to go? Are you going to go get service? Are you going to do it yourself? Or are you going to keep coming back to class? Because that's also an option. So that kind of goes over everything that we're doing. So just before we break into a little bit of sort of improvised speech, do we have any questions about what we're going to be talking about or anything in particular that anybody wanted to bring up today? A break. When is our break? Shaniqua.
A break in class or a break just in like class sessions? Yes, we can take a break right now if that's okay. Is that okay?
Yeah, let's go ahead.
Okay.
Let's go ahead and take 5 now, and then we'll come back. Cool.
It does.
No worries. No worries. Now that we're back, I want to have a little bit of a conversation about a couple things. First of all, one thing that I want to say is that while I am going to be up here teaching and talking and leading us through all of these conversations, I want to make sure that you feel free to ask questions when they appear. So if there's something you're worried about, throw your hand up. I'm always ready to stop and genuinely have like a nice long conversation right in the middle of class. If we don't make it through some of the content that I have, that's okay, because the things that are more specific to you are the things that I find more important anyway. I want to have relevant conversations. I want us to have really helpful things so that when you come back, it might not just be for the day slides, but because you have something that you need an answer to and we want to talk about. And I might not always have the perfect answer, but you bet if you ask me a question, I can't figure it out, I'm going to come back next week and have researched it all week long, use my entire weekend to make sure I get the right answer for you. Now, following that, I want to talk about our website because I've talked about it a couple times and I just want to make sure that you guys see it, you understand kind of how it's working. So this is activeretirementinvesting.com. You will see it on several of our pieces of paper. It's on the bottom here. It's on the bottom here. It's on everything. And it will continue to be, it's on your nice little bag. So if you want to advertise our website, please carry, I guess, 1 jug of milk from the grocery store in this. But this is our website, activeretirementinvesting.com. And you'll see up at the top right this big Start Learning button. For me, that's what I want to be the first place for you to hang out at. You click Start Learning, and you will be presented with a couple different learning paths. So the live seminars, obviously, that's where we are today. You go over to the recorded seminar, and these are the ones from the previous round, but you will see recorded seminars from each class, and you'll be able to break this out. So for our introduction, you break this out, and then there's going to be a video on the side along with 2 download links for the handouts that we're giving out today. So you see that there's the helpful financial terminology. You're going to get that terminology pamphlet right here. You can click on it, and it's just going to download right to your computer for you to open at a later time. Now, also, you're going to have the live seminar descriptions. So you'll see here's a little description of the Renaissance Society, a little bit about the other places that we do workshops. And if we do specialty workshops, we are looking to do as many of these in different places, whether they're 1 day long, 2 days long, a week, a couple of weeks, whatever the case is. We're looking to do this in as many places as possible because I want to help as many people as possible and make them feel confident. So here you can click a link to send us a message if you want us to come by your place at any time. But next, I want to also look at the third path, which is the glossary. And this is just a helpful little place where you can find all sorts of different definitions of different things. So if you've got a question, you can hit Control or Command F and you can search something like duration, and then it's going to bring you to the definition that tells you about that thing that you're wondering about. We're going to try and build this out as much as we can. It's a starting place, but we're going to try and make this as useful as possible. You can also go to our mission page and you can read a little bit about what I am doing here. In fact, why don't I just read through this for you? So through active retirement investing, we exist to demystify financial planning through accessible, human-centered education that empowers pre-retirees and retirees to make confident decisions about their financial future. Our commitment is to deliver complete transparency and plain English guidance without gatekeeping information or pushing sales. I just want to give it out. I don't have a desire to give you just enough information that I can put. Like, that's not my goal. I just want to see people walk out of here confident, because the people who are the most understanding, that are the most confident, that feel the best about it, one, if you do become somebody's client, you're going to be great because you know what to expect, you know how to push them for the right things, and it just makes the whole relationship better. And then if you go out there, you can also guide your friends, your family, and the people around you to also make better decisions. So we measure success not by conversions, not by sales, not by revenue, but by the confidence and clarity that our students gain after being here with us. Whether they choose to manage their finances independently, improve their current advisor relationship, or seek professional help with full understanding of what they're doing. Because again, at the end of the day, it's not about having to be the professional and then also hire a professional and always be on top of it like they are, but understanding what are the benefits, what are you getting, what are you deferring, and just really being present in that relationship. Let me go down a little bit. So we believe, personally, this is really my belief, that financial planning has been unnecessarily overcomplicated by an industry that profits from confusion. The industry loves to create these bundled products with all this extra stuff where you're getting all of these things in one product. And there's not really, you don't understand that you can create pieces of that yourself, or you don't understand how high the fees actually are going to end up being, where things get charged from. It's just a lot of, here's this wonderful thing, why don't you buy it already? And when it comes to your financial future, it's really important to be able to understand those products that are being put in front of you, whether they come from somebody who's giving you advice or somebody who's there to sell a product. It doesn't matter. By focusing on personal truths, emotional realities, and practical understanding, we try to create an environment where complex concepts become approachable and actionable. And that's something I want to lean on. I focus on the people side of this business because it's the most important thing. One of the most important things about risk is, yeah, there's a certain level of mathematical risk and up and down movement you can take. But there's also these invisible little barriers where when you cross over them, you will emotionally change something and redirect your path into a different way, and it's not going to get there. Understanding the purpose, understanding the why of getting from point A to point B makes it much easier to be able to excitedly and really correctly go in the right direction towards what it is you're trying to achieve. So I want to lean on that people side of the business. I really want to lean on the emotions. I want to lean on the understanding and basically getting on board with what we're doing. Because if you're not on board and you're going to just kind of get off the plane at some time, like it doesn't matter how far the plane goes if you're not going with it. So you got to be in on the conversation. You got to be in on the plan. Above all, we put student empowerment first. I want to deliver extraordinary value with no expectation of anything back. I just want to make sure that this helps you be empowered and helps you move forward in a way that makes you feel confident about what you're doing and confident about talking to the people in your life who may need help or are willing to help you. I want to build goodwill through genuine education and ensuring every single participant leaves equipped with the knowledge and confidence to take control of their financial journey. Now, of course, I want to do all this because I want to create goodwill for our company and for me, for us as professionals. I obviously want you to see us in a positive light. That would be great, just generally. But I want to do that by just simply delivering goodwill and delivering good faith education so that you can take it, go forward into whatever relationship you're going to. So that's a bit about our mission and what that means. There's a little introduction video down here. I'm not going to play it. That's for you to go find and watch yourself. Okay? That's a little Easter egg. You've got to get there. Now, there's another book on or another page on here called Get the Book, and it talks a little bit about this book and where you can download a digital copy as well as get a link to an Amazon listing. So you can also always email us and I'll send you one for free. You don't need to pay $10. But if you're impatient and you have Amazon Prime, you can hop on there. So if you want to get that, or if you want to recommend it to somebody else, you can send them to this page. We'll also have a class calendar, which I know you've probably got 2 or 3 of those already, but if you want to just see when the next class is and where it's being held and what we're talking about, all of that is also going to be available on this page right here. So that is really most of the elements. I'll scroll you through our homepage a little bit so you can see. We talk about our approach a little bit. We have some links to each of the different things, just like you get in the Start Learning tab. And there are some biographies about each of us. So these talk a little bit about who we are, what I do, what Bill does, where we come from. And yeah, that's pretty much all. Oh, there's this nice little section about what we've been up to. So things that we've been doing. Bill actually spoke at the Sac State Executive Guest Speaker Series, and that was really fun, where we met a bunch of younger guys from some of the business and finance degrees here, like Grigor sitting in the middle of this class, who is now helping us with putting this together. So we actually pulled a resource from ourselves. At Sierra College, we do a full presentation. And then also, Mosaic, our broker dealer, they have this big, huge conference. That one was, where was this one again? Do you remember?
Was it Las Vegas?
I think it was Las Vegas. Florida. Oh, Florida. Yeah. This one was Florida. So this one was in Florida. And we actually gave a presentation talking about what we're doing here today to a room of like 100 advisors that was just full packed. So it was really fun to go and talk to a bunch of them and really just show them the power of what we're doing and trying to help people out. And some people were very interested in our process. And then, more things that we do, they'll show up here. But I just want to give you a good idea of what this could be for you, kind of resource. And if there's anything that you think would be helpful, if there's things you have questions about, I want to get feedback. I really do want you to take the time to email us or join our newsletter and get content from there, and really just stay in contact with us in and outside of the classroom so that I can make sure to bring as much actionable value as possible. After classes, we will stay until the last person leaves. So if you've got questions, please come take my time. I'll be here. I'll be ready to answer as much as I can. But that really is our website. And just know that you come here, you hit start learning, and you'll find everything that you need. So just remember that. Now, that's about all that I have for today. We've got 5 extra minutes, so I just want to pause and just see if anybody has any questions. Yes, you do.
This was so interesting, and not to be a cynic, but 2 days ago in the New York Times, there was a story about Jonathan Kleisner, the millionaire hedge fund manager who left Wall Street to become an emergency medic, and he's now working for $25 an hour, doing extremely tough work. And he referenced that the work he did was completely soulless, and yet he became a trillionaire. And so your story about people and the people side and humanity is in such contrast.
Yes.
How do you square that? Because in typical financial pursuits, the relational side is generally not considered part of the equation.
Yeah.
Infested water.
Of course. So I think it's important to understand the different scope of the finance industry, because it's a very wide industry. There's a lot that's in there. When we talk about investment banking, it kind of is like that classic idea of what people think about. It's, people work at 12, 16-hour days and trying to crunch numbers and make as much money as humanly possible. That's where, a lot of the big top graduates will go from the big schools, and it's all about making money and all of this. But the way that I think we separate it is, the reason that I work with clients is we lay a plan of action for what they want, and I help them get to where they want to go. And I provide my value by, one, being their guidance in using the proper products and not getting lost in it. And then also just being sort of their coach and being the person that they can talk to and have a relationship with, where I understand where they're coming from, and then I understand the finance landscape. And the other thing too is, like, we don't work in products. We are not in the business of creating investment products. We're not creating things to sell people. We don't operate on commission. We don't operate on trading fees. We operate on a percentage of management in terms of our actual business. So the idea is to have assets within our purview and then make sure that we follow the client's best interest. And by it being on our platform, that is how we will generate our fee. Yes. No, that is actually very much the standard now. That's very much the standard nowadays. Most financial planning firms will be fee-based. Some of them may have some small commission products, just because there are some things where it's easier to get a product if you sell it via commission. Some things like annuities, and they just haven't quite meshed yet, but we are fee-based, and that's where we come from. In fact, if you want to tell your story about becoming fee-based a little bit.
Yeah, but I was gonna say one thing is all the more reason to meet and work with, if you have a family member or financial advisor, get to know them, to know their ethics. Because if it's just a sale of a product, or like that hedge fund manager, they got paid, let's say on average, 20% of the profits, 2% a year, and they gambled other people's money, the people that are successful you read about and the ones you don't. And then he has the ability to go work at $25 an hour. My question for him would be, did you donate all the money you made?
Yeah.
And then work at $25 an hour? That'd be okay. I still have at this moment, as I'm talking to you, I have a high tinnitus hissing in my ears from the range working for the sheriff's department for 37 years as a non-paid reserve deputy sheriff. So I felt pretty good about that, and coming into the business while working, being compensated for your time, but not getting super rich. You want to get to know the advisor at that point. And the cool thing is about the regulators, they're really pushing hard on ethics and morals. We actually have to take tests on that on every day. So AI is going to be out there making money for themselves very quickly for the bank and the institutions. And we want to use AI to improve our quality of work, but it's all the more reason to meet somebody face to face. And we get a chance to meet an advisor, not that you would work with him, but get to know them day to day and find out who they really are. That's the cool part. But I would like to know if this gentleman donated his money. Okay, because he can lecture us all he wants because he's already made the money. But if he's given most of us away and then have a small pension, I totally respect that. But there are a lot of volunteer jobs we can do.
Yes.
Okay.
Advisor, it's all about money, it's all about numbers. And I only met her once a year and there wasn't that much, I didn't learn anything from her. But since when he was talking about in person, that personal relationship, I really like that. Because it made me feel important. He taught me a lot of stuff. He explained everything to me, what it is and why he's doing it. And that helped me a lot. To me, that personal relationship was more important than the numbers.
Yeah.
Well, you say.
Very much appreciate those kind words.
Well, one of the stories, we had a client come in 2 days ago and he's been a client of ours for like 30-some years. His mother left him money and now he has dementia issues. He got to the office, but we've hired him a fiduciary day-to-day bills to make sure that his daily care is in good shape. The person doing that has had his house cleaned out because the county was going to kick him out of his house. He was a hoarder. So we hired this fiduciary. She came in, cleaned the whole house, and he has hot water and everything that he needs, all his utilities, and he has the food that he needs. So financial advisors and planning in the future needs to be one-on-one personal if you work with somebody or a family member, not some AI or some big company that scales it down to telling the advisor, no, you can't do this, you've got to sell this product. So,
Yeah, absolutely. Okay, yes. So really it is a responsibility. So depending on the type of field that you're in, when you're a financial advisor, when you're giving advice for money, what you are held to the fiduciary standard. And it's essentially the idea that we have to act within within the client's best interest ahead of our own. So they always have to come first before self-interest when it comes to how much money we would earn on any given transaction or how much something would earn us over time. So if we become audited by somebody like the SEC or our compliance department and they find that we do not act within fiduciary duty, I could lose my license and not be able to practice ever again. Yes, that's industry-wide. And so, right.
if somebody says, I'm an advisor, EROR, whichever, they have to maintain the fiduciary standard, but if they're not an advisor, then they come through another best interest standard and everything. So
Yeah.
regardless, broker or advisor, we're all held to that standard. The insurance companies, however, we're not seeing that yet. It's something to keep an eye on. But
Yeah, and so that'll be just really important to understand what's the nature of the relationship of the person you're talking to. So understand like what it is they do with their company. You can ask them about like what are their conflicts of interest. That's something we also always have to disclose. So always be ready to ask that question. What are your conflicts of interest? Tell me about that, and then they must be disclosed.
If he does something that is violating the client, but also if we don't tell the government, look, this looks suspicious, we can get in a lot of trouble. And I have frozen an account for a client that was being taken advantage of. We're by the government's design, we're now stepping in, having to be fiduciaries and then take care of a client if something sounds fishy. We're supposed to step in and take care of it.
Yes.
Could you give us maybe like a range Well, because in the past, I've always worked where my financial advisor only makes money off a certain percent of a sale or
Mhm.
purchase, right, of the stock or ETF or whatever. Could you explain maybe how that's changed and what the typical range would be?
Sure, so there's a few different ways that fees can be charged. Commissions do still exist. That's possible. I could do a commissions-based account if I wanted to. But more commonly, you'll see fee-based advisors and they'll charge it in pretty much four-ish ways. You'll have hourly fees. So if you just get an hourly consultation, it's just you meet with them, you chat it up and you figure out some things. You might have a retainer fee. So you might grab them for the year or 6 months or a quarter or whatever it is, pay some flat fee, and then you have some certain level of service you get over that time. It's like, you know, an attorney or something like that. You might get project-based. So if you're getting a financial plan, they might have a flat cost for that deliverable product, or they charge some sort of deposit and log up their hours. There's a bunch of different ways that that can work, but it's usually on either a deliverable time that they spend with you, or what's called assets under management or assets under advisement, where they go, here's all the money you have with me or I am supervising, and I will charge a percentage figure of that for the privilege of managing that portfolio. So yeah, so it can be a widespread. So if we're talking about the AUM model, it's very standard. When we get all the way down to that class, we'll have all those numbers there. But generally around maybe between 0.75% all the way up to 1.5% per year could be a range of assets under management fees. They can range lower, they can range higher. It depends on the firm. And just that's where it's really important to understand where you're deriving the value from. Because it's totally fine to pay more for something if you feel like it's valuable for you, or if you just really like the person and don't mind. That's also a totally fine reason. There's plenty of reasons to pay more or to pay less. A lot of people will shop down. So if you want like a really cheap advisor, places like Schwab and Vanguard and Fidelity will often offer a lot of complimentary services just for being there, which is kind of nice. And then financial plans can be anywhere from like $2,500, $7,000, $10,000. It really depends mostly on the complexity of the product being delivered. And then hourlies are all over the
At
place.
the end of the year, if you're doing the annual review, kind of annual visit. If I have money over here being managed for a fee, say 1%, it's 100,000 or so, costs me $1,000 a year. We do regular annual reviews that have to do with your real estate, your rentals, your other investments, your estate planning, all these other things. And if you added up your other assets, this portfolio may be 100,000, but then you got another 2 million over there. That makes the fee really small if they're working on everything. But that's why you need to have, if you work with somebody, a face-to-face, one-on-one, or a Zoom. We have clients out of the country and other states, but a one-on-one environment. And you may call and say, look, I don't like what I'm seeing in the news. This company scares me. Which stocks of funds do I have that has that? He'll go back and scan them and find out all the stocks in which funds. And we've had clients, right, ask you to get them out of anything with NVIDIA in it. And the next day you get a call, I want to be in a fund that has NVIDIA in it. So he customizes portfolios either in a model or a custom and updates it on a regular basis. And then if there is a fee, you got to look at, I'm getting all this other stuff without being charged. So whoever you're working with, have them come to the class.
Yeah.
Because we want to put them to work and make them earn their fees at this point.
Okay, anything else before we wrap up? Okay, well, thank you very much, everybody, for coming and for staying all the way past the end, almost 10 minutes. I appreciate you all very much, and I can't wait to see you next week. Thank you.